In this section, we are going to discuss about primarily the concept of futures versus forwards. What is the difference between futures and forwards, and how some of these instruments get used for hedging purposes and speculation purposes. We'll introduce these terms, and then we go about trying to discuss about these terms as we go along, right? So first things first, let's understand that when we were talking about the concept of forwards, there were a set of risks that get involved in the case of forwards, right? Now, these are things that need to be addressed because these risks exist whenever we are trading in the case of forwards, right? Now, what are these risks? If you think about it, uh, we said there is a farmer and we said there is a buyer, right? Now they are effectively getting into some sort of a contract. But this is a contract between two parties. So we don't necessarily know if both the parties will turn up on the final contract day, right? What happens if the losing party does not pay up, right? Default risk, also commonly known as counterparty risk, is the risk that one party does not pay the other party at the end of the contract. Now that's a reality in forwards because there is no mechanism to regulate it, right? You can try and regulate it via legal clauses, but eventually legal costs could be huge in terms of eventually ensuring that the losing party pays up, right? So while legal clauses exist, businesses don't want to get into all that, right? So that's one part of the risk that comes in. The second part was there was a contract to buy rice, but what kind of rice is not known, right? So is the quality standard? Is the quality at a particular metric? Above it, below it, we don't know. So what if the quality of rice supplied is not standard, right? In which case the farmer might sometimes feel that the quality is better than what 90 rupee commands. The buyer might feel that the quality is worse than what 90 rupees commands. So both the parties could essentially at various points of time, depending on the outcome, be dissatisfied with what is happening. The third one is called price risk. Now, what is price risk is essentially this information is not easily available since these two parties are essentially trading in a sort of an isolated manner, right? So these are isolated. There is no mechanism whereby the farmer and the buyer have information or access to information of what is the price of rice in another market, right? So no access to market data around rice prices, right? Because these are two independent guys dealing with each other. One of them believes price might be 90, the other one also believes price might be 90. Who knows if the price is actually 80 in the real market? Who knows if demand supply has changed the dynamics, right? So there is a sort of a risk that comes in because of them being trading in an isolated manner, right? Now, this happens because essentially futures are what is known as over the counter products, right? Also known as OTC products. What does over the counter mean is that there's no standard product that is available. Two parties meet each other, and depending on their level of comfort with each other and the fact that they mutually agree on a certain kind of a contract, they will create a contract. That's called a future. So that's called a forward contract. So forwards are essentially over the counter products, and thereby you have three broad risks, that is default risk, quality risk, and price risk that flow in, right? Now, how do you deal with it? In real terms, while sometimes you may not need to deal with the risk because if you trust the other party, that's fine. But in certain cases, you may want to remove this risk or de-risk yourself from this, right? At this point of time, instead of having an over-the-counter product, we introduce the concept of what is known as an exchange. right? So what does an exchange do? Right, so let's introduce the concept of an exchange. The primary functions of the exchange are given as below. It acts as a watchdog. In other words, it's a regulator. It ensures that everyone fulfills their share of the promise. It helps in standardization of transactions, which means it defines what quality will come in, right? So quality and quantity get defined by these guys. And it aids price discovery purely because it's a market where multiple participants or lot of players come in, right? That's the function of an exchange. Exchange is essentially a platform where multiple players interact, right? So multiple players interact, and it is the responsibility of the exchange to ensure that there is no sort of default risk. They do it using various mechanisms which are probably better discussed at a later stage in our curriculums. But at this point, let's assume that the exchange is the watchdog who ensures that everyone pays up. So that's the primary responsibility. It removes counterparty risk. So this essentially removes your default risk. This one removes the risk of the second risk, which is the quality risk, right? So you remove quality risk here, and the third one removes the price risk. So essentially, because it's a market, there are like thousands and thousands of players who are dealing with each other. There is a better discovery of the price. If the entire market is trading on this exchange, then the price of rice that is determined in this exchange will probably be a better estimate of the price than if two parties were dealing with themselves individually, right? Now, the moment you introduce the concept of an exchange and you bring in an exchange into the equation, the entire discussion that we did in forwards changes to what is called as a future, right? Forwards, when standardized and traded on exchanges, are known as futures. Right now, how does this work? Essentially, remember there was a farmer and there was a buyer and they were getting into a contract. Now the contracts change. The contract now becomes between the farmer and the exchange and the farmer, where the farmer says prices will fall below 80, below 90. Exchange says that the price will go above 90. And then the contract is between the exchange and the buyer and the exchange, where the buyer says the price will go above 90 and the exchange says the price will go below 90. What is the exchange doing essentially? The exchange does nothing but it matches orders, right? So in between, the exchange will try and find out if the farmer comes and says, I want to bet on the rice price going below 90, the exchange is trying to find out who is saying in the market that the price will go above 90. Now the exchange will match these two orders, and the moment the orders get matched, there is an execution of the transaction. Now the good part is the parties don't know each other. So the parties in contract may not know each other. They only know that they are dealing with the exchange. There might be some party behind the exchange, but practically the exchange is supposed to make good if they lose the bet, right? So if the buyer loses the bet, the buyer pays to the exchange and the exchange pays to the farmer. If the farmer loses the bet, the farmer pays to the exchange and the exchange pays it to the buyer effectively. The exchange takes a small fee for this entire transaction. That's how they make money and that's how they create this platform. So now the exchange becomes the regulator and in fact the counterparty for both the players. The exchange manages the risk by an agency called the clearing house. which makes trading parties settle their gains and losses on a daily basis by marking them to market. What does this mean? If the contract for rice was put up at 90 today, right? And tomorrow the price goes to 89. At this point of time, while we have not reached the end of 2 months, who is winning the bet? The farmer is winning the bet. So on this day, when it is 89, you will see farmer will see +1 in his account, buyer will see -1 in his account. Now the exchange ensures that both the parties make a payment by taking some money from them upfront. So the exchange takes some upfront money payment, and that's called as margin money. So if you are putting a trade on, the exchange out of this 90 might want to keep out. If you're putting a contract for 90 rupees, the exchange might want to keep 10 rupees with itself, right? So that's broadly how the mechanism of an exchange works. Let's understand it once again. So let's say the farmer says price will go below 90. The buyer says price will go above 90. They are going and looking at the exchange as to what the contract is. The exchange matches the order, and once the order is matched, at this point of time, the exchange asks for margin money. Now both these guys will pay. So both parties pay margin money, which is basically a reversible transaction. When you close the trade, whatever is the gain loss is adjusted to the margin money and given back. So effectively at this point, the farmer deposits, let's say margin money is 10 rupees. That's a assumption we are making. If the margin money is 10 rupees, the farmer will deposit 10 and the buyer will deposit 10, right? Now the next day, so both their accounts, the farmer puts in 10, the buyer puts in 10. The first day, if the price becomes, so let's create a table of the farmer and buyer. If the price goes to 89, the farmer sees +1, the buyer sees -1. In other words, the accounts of the farmer will show 11, the accounts of the buyer will show 9. Remember, they put in 10, 10 initially. If the next day the price goes to 92, the farmer will see -3 from this point and the buyer will see +3. So -3 will take it to 8 and +3 will take it to 12. Note that if they put in the trade at 92, at 90, then 92 would mean that the farmer is losing 2 and the buyer is making 2, right? That's what is happening in their respective accounts. This concept is known as marking to market, right? This concept is known as marking to market, and that's how the counterparty risk is mitigated, because the exchange ensures that this payment is done on time. The exchange uses the agency called clearinghouse, whose sole job is to actually do this calculation on a day-to-day basis and settle it. So futures, because they get marked to market, because the futures get what is known as marked to market, that removes the risk. That is effectively the de-risking procedure in futures, right? So that's what futures are. They are essentially forwards, but they are standardized one and they are traded on exchanges, right? So there is a regulator in between who takes care of the entire transaction. That's why futures become the more important and interesting point. These are called as exchange traded products, right? So let's quickly summarize the forwards versus futures argument. Forwards are over-the-counter products, also known as OTC. They are over the counter, that's OTC, right? They're useful when standardized contracts are either not available or not required. If there is a requirement of a customized contract, that is where forwards will be useful. If there is a requirement of standardized contracts, that is where futures will be useful. It is also useful when both parties trust each other. For example, two financial institutions dealing with each other. If two banks are betting on a particular currency, for example, right? An Indian bank could be dealing with a US bank and they could be dealing on the currency value of USD INR at 70 rupees per dollar, right? So $1 will mean 70 rupees, and they could be basically creating a contract on this. If these are two banks involved, then banks are trustworthy because they are regulated any which ways, right? And they've been existing for a while. In these cases, over-the-counter products work. So the keywords here are trust and customization. If you need customization and if you believe that the other party, counterparty, is trustworthy, you will go ahead and use forwards. If that is not the case, then you have what are called as exchange traded products, standardized products. Standardized products would have contract sizes defined, right? They would also have contract tenure defined. So for example, if you look at the futures market on Indian stock markets, you typically have futures which are 1 month, 2 month, and 3 month tenure. You don't have anything more than that, right? In certain cases, you have more than that as well, but for most of the stocks, you have only these three tenures. If I want to create a customized 1.5 month contract, that will only come if I customize it using a forward. I can't have a 1.5 month future because that's standardized. The exchange gives a certain tenure. And for example, if we are in a particular month, you will have that month, the next month after that, 3 months kind of contracts that are available. There's nothing else that is available. It is useful in risk mitigation because of the presence of the exchange. The exchange kind of de-risks the entire trade there. In this case, the counterparties may not know each other, and most of the times this is cash settled. Remember in our discussion on rice, the first example where we said the rice is delivered to the buyer, that's actual delivery based trading. The second example where we were saying it's like a bet, that's usually cash settled. Future trading almost always is cash settled. Forwards in some cases could be delivery based, right? So there could be delivery based trades here, but futures almost always are kind of cash settled. So for all practical purposes, they are like bets, nothing more than a bet, right? That's the discussion on a forward versus a future. Where are futures becoming important for us and how do they really form the crux? Rest everything is exactly the same, just that this time there is a party in between that is dealing with the regulatory aspects of the things, and there's this party that takes care that there's no counterparty risk, which could have happened in our discussion on forwards, right? That's about forwards versus futures. That's it in this particular section.